If you're new to investing and you're looking for a risk-free investment option, then this video is for you. Today I'm going to be talking all about Treasury bills, also called T-bills. In this video, I'm going to cover what T-bills are, how to do T-bill laddering, how you can purchase T-bills, and make sure you stick around to the very end because I'm going to cover some important pros and cons that you definitely need to consider before investing. Let's get into it. So what exactly are Treasury bills? Treasury bills are short-term securities that are backed by the US government. They are called short-term because they have a maturity period of 1 year or less. Treasury bills can be bought in varying maturity period lengths, ranging from 4, 8, 13, 17, 26, and 52 weeks. Additionally, Treasury bills are sold in increments of $100, with the minimum purchase being $100 and the maximum $10 million. T-bills are bought at a discounted price. So what that means is that a T-bill has a face value price, but it is actually sold for less than face value. For example, you may have a T-bill that is worth a $1,000 face price, but you may buy it for $950. And at the end of the investment period, say if it was 52 weeks, for example, you would receive $1,000. So you're receiving back the original $950 that you paid, as well as $50 of interest, which is the difference between what you originally paid, $950, and the face value of the T-bill, $1,000. As you can see from this chart, T-bills are currently providing an interest rate of 3.5% and upwards. So compared to the average savings account, which provides an interest rate of 0.2%, you can see that T-bills are a great option to consider of places where you should keep your money right now. Since T-bills can be bought at various interest rates, you can do something called T-bill laddering, which is where you buy a series of T-bills at varying maturity periods, which can be rolled over to a higher interest rate each time the T-bill matures. And this strategy works well in economies where inflation is rising because T-bill interest rates rise with inflation. So in such an economy, you can expect that the T-bill interest rate that you would get this week would be lower than the T-bill interest rate of next week and next month. For example, you could buy 4, 8, and 13-week T-bills all in equal amounts, say $1,000. And then when the 4-week bill matures, you take that money and reinvest it into a 13-week bill. And when the 8-week bill matures, again, you take that money and reinvest it into another 13-week bill. With this strategy, you're able to capitalize on the constantly rising T-bill interest rates, and thus you get more bang for your buck. And this strategy can be repeated until interest rates start to decline, at which point this strategy would no longer be favorable. At this point, you might be wondering how exactly to purchase T-bills, and it's actually very simple. You can do this through treasurydirect.gov, which is a US government official website. And on this website, you can buy the T-bills through an auction. So auctions are held weekly for the 4, 8, 13, 17, and 26-week T-bills, and monthly for the 52-week T-bills. On treasurydirect.gov, you will first need to create an account. Then you can go in and select to purchase T-bills. You will need to select the maturity length and add in how much money you would like to invest. Next, I want to go into some of the pros and cons of T-bills. The first pro is that they are risk-free because they are backed by the US government. So this means that you are guaranteed that you will not lose your initial investment. So this is so great, especially for beginners who are skeptical and you just want to try investing, this is a great place to start. The second pro is that there is such a low barrier to entry because of the minimum investment amount. So again, the minimum investment amount is only $100, which opens the door for so many people to start investing in T-bills. And the third pro is they are partially tax exempt. So for T-bills, you do not have to pay state or local income taxes on the interest that you earn, but you are responsible for paying federal income tax. So you're not completely off the hook, but it is a pretty good deal. For the cons, the first con is that you do not receive interest payments leading up to the maturity date of the T-bill. So for T-bills, you'll receive your interest earned at the very end, which does limit your cash flow. So it's not like stock dividends where you're receiving payments throughout the time that you're holding the security. All of that will just come at the very end. Second con is that T-bills offer lower interest rates than other investment types. So T-bills will not give you this crazy high return on your money because they are lower risk. So if you're more adventurous and willing to take greater risks with your money, you can get more out of your money by investing in stocks, ETFs, and index funds instead. Thank you so much for watching my video. If you enjoyed this video, please subscribe to my YouTube channel because I'm uploading a new video every week. If you have any questions about Treasury bills, please leave them in the comments down below and I'll get you a response. And if you enjoyed this video, then watch this next video over here, which is about another type of US-backed security that can protect your money from inflation.